Does BlackRock already own XRP? And more importantly, do they have plans for the XRP ledger that go far beyond what most people are paying attention to right now? That's the question sitting underneath a lot of recent conversations, clips, and comments. And it's not a question you answer by looking at price charts or social media hype. It's a question you answer by understanding how institutions actually move, how they signal involvement, and how large financial transitions unfold long before they become obvious. Because here's the reality most people miss. Institutions don't announce what they're doing while they're doing it. They position first, they test quietly, they build relationships with regulators and infrastructure providers, and only later does the public narrative catch up. So when you hear someone like Jake Claver say very carefully that BlackRock is likely far more involved than people realize, that's not meant to excite you. It's meant to tell you to pay attention to how things are being said, not just what is being said. And that's what this video is about. Not making claims, not promising outcomes, but connecting dots that on their own don't look dramatic, yet together start to outline a very different picture of where XRP fits in the next phase of the financial system. Before we go any further, let me be clear. This is not financial advice. This is educational content. The goal here is to help you think more clearly about how institutions behave so you're not reacting emotionally to headlines or price moves. And if you appreciate calm, grounded breakdowns like this, take a second to like the video, subscribe if you haven't already, and drop a comment below. The question I want you thinking about is simple. Are you looking at XRP as a trade or as infrastructure? Now, most retail investors approach crypto from the outside in. They start with price, they start with narratives, they ask what's going to pump next, what's being talked about on Twitter, what ETF news might move the chart this week. Institutions work in the opposite direction. They go from the inside out. They ask what system is being built, who controls the rails, what regulators are comfortable with, and which assets actually solve problems at scale. That difference in perspective explains why conversations around BlackRock, XRP, and the XRP ledger feel so frustrating to a lot of people. There's no press release that says, here's exactly what we're doing. There's no clean timeline. And there's definitely no short-term price validation. But that doesn't mean nothing is happening. In fact, in institutional terms, that often means things are happening exactly as planned. When someone with access to institutional circles says, I can't say much, or this is more involved than people realize, that's not hype, that's constraint. Large firms like BlackRock don't operate in public comment sections. They operate through custodians, pilots, partnerships, regulatory engagement, and long-term strategy. And they don't care whether retail understands it in real time. This is also why it's important to separate speculation from structure. Asking whether BlackRock owns XRP is actually the least important version of the question. Ownership is retail framing. The more important question is whether the XRP ledger fits into how large institutions plan to move, settle, and manage value in a tokenized financial system. And that's a very different conversation. At the same time, you're seeing a subtle but important shift in how other assets are being discussed by influential voices. Bitcoin, for example, is increasingly framed as a store of value, not a global payment system. Even Elon Musk has been clear about that distinction. And that matters because it highlights something crucial. Not all digital assets are competing for the same role. Some are narratives, some are investments, and some are infrastructure. XRP has always sat in that last category. It was never designed to win popularity contests. It was designed to move value efficiently, cheaply, and at scale across systems that don't naturally work well together. That design choice changes how institutions evaluate it, and it changes how involvement looks from the outside. So when you start seeing discussions about BlackRock, tokenization, the DTCC, settlement layers, and regulated infrastructure all happening in the same time frame, the mistake is treating each of those as isolated news items. Institutions don't think in headlines. They think in systems, and systems are built by aligning regulation, liquidity, technology, and trust, not by chasing price. To understand why XRP keeps coming up in institutional conversations while price action stays muted, you have to look at how large capital actually thinks about Bitcoin versus everything else. This is where a lot of people get uncomfortable because it forces you to separate narrative dominance from functional dominance, and those are not the same thing. Bitcoin still commands attention. It still attracts headlines. It still absorbs massive amounts of speculative capital. But at the institutional level, the conversation around Bitcoin has quietly shifted. It's no longer being discussed primarily as a payment system or settlement layer. It's being discussed as a store of value vehicle, an ETF product, and a macro trade tied to liquidity cycles. That distinction matters more than most people realize. When Jake Claver and others talk about where family offices, hedge funds, and asset managers are focusing their attention, you'll notice something subtle. Bitcoin is treated as exposure. XRP is treated as infrastructure. Those are two completely different categories. Exposure is something you trade. Infrastructure is something you integrate. This is why you're hearing arguments that Bitcoin ETFs are not held by long-term believers. They're held by participants who are perfectly willing to short them, hedge them, or exit them aggressively when conditions change. ETFs are tools for price expression, not commitment to a network. That's why futures markets, options, and structured products matter so much for Bitcoin, and also why they increase volatility rather than stability. XRP doesn't fit cleanly into that framework. It's not being positioned primarily as an ETF trade. It's being positioned as a settlement asset, a liquidity bridge, and a system-level component that connects regulated entities. That difference alone explains why price behavior looks so different. Settlement assets are not supposed to be volatile during integration. Volatility is a liability when you're trying to move large amounts of value predictably. This is also where comments about Bitcoin's intrinsic value come into play. When people argue that Bitcoin's base value without institutional narrative might be far lower, they're not attacking Bitcoin. They're pointing out that a large portion of its price is driven by belief, scarcity narrative, and financialization. There's nothing inherently wrong with that, but it does mean Bitcoin's role depends heavily on perception. XRP's role depends far less on perception and far more on utility. It either works as a bridge asset or it doesn't. It either reduces friction or it doesn't. It either settles fast and cheaply or it doesn't. That makes it less exciting in the short term, but far more attractive in environments where reliability matters more than story. This is why you'll hear people say the opportunity in XRP is greater, even while acknowledging Bitcoin's success. They're not saying Bitcoin fails. They're saying Bitcoin is already priced as a narrative asset, while XRP is still being evaluated as infrastructure. And infrastructure doesn't reprice until it becomes difficult to avoid. Another thing most people miss is how deeply XRP and Ripple are embedded in regulatory conversations. Institutions don't want to fight regulators. They want to work with them. Assets that already have relationships with regulators, central banks, and financial institutions reduce friction dramatically. That's not something you can bolt on later. It has to be built over years. So when you hear that Ripple and XRP are connected to regulators, payment corridors, custodians, and financial institutions globally, that's not marketing fluff. That's exactly the type of positioning institutions look for when deciding which systems they can safely build on. It's boring, it's slow, and it's incredibly valuable. At this stage, the mistake is assuming all crypto assets are competing in the same race. They're not. Bitcoin is competing for narrative dominance and macro exposure. XRP is competing for relevance inside the plumbing of the next financial system. Those races have different timelines, different signals, and very different endgames. This is where the conversation stops being theoretical and starts getting uncomfortable for people who are emotionally attached to certain narratives. Because once you strip away hype and tribalism, the question becomes very simple. What actually works for global payments and settlement at scale? Even some of the most influential voices in tech have been blunt about this. Bitcoin at its base layer is slow, it's expensive, and it was never engineered to handle high throughput, low cost, real-time transactions across borders. That doesn't make Bitcoin useless. It just defines its role. A store of value is not the same thing as a settlement network, and confusing those two has caused years of misunderstanding in this space. When Elon Musk says Bitcoin is better suited as a store of value than as a transactional currency, he's not attacking it. He's describing a design limitation. Throughput, cost, and speed matter enormously when you're talking about payments. You can't move global commerce on a system that chokes under load or becomes prohibitively expensive when demand increases. That's not opinion, that's engineering. This is where XRP's design starts to matter again. XRP wasn't created to win ideological arguments. It was created to move value quickly, cheaply, and reliably between different currencies and systems. That's why it keeps showing up in conversations about payments, remittances, and settlement. Not because it's trendy, but because it fits the requirements. And this also explains why joke alternatives or meme-driven solutions don't actually solve the problem, even if they're occasionally cheaper or faster than Bitcoin in isolation. Payments infrastructure isn't just about sending value from point A to point B. It's about reliability, liquidity, compliance, and integration with existing financial systems. Serious institutions are not experimenting with novelty. They're looking for systems they can trust under pressure. Here's the part most people overlook. Institutions are not trying to make money on settlement assets. They're trying to move money through them. That distinction changes everything. If an asset is unstable, thinly traded, or legally questionable, it introduces risk. And in finance, risk in the plumbing is unacceptable. That's why assets designed for payments tend to look undervalued or unexciting compared to speculative plays. They are not priced for entertainment. They are evaluated for function. And function doesn't show up as hype. It shows up as adoption, integration, and quiet use. This is also why the conversation around Bitcoin, Ethereum, Solana, and XRP is starting to diverge. Bitcoin holds the store of value narrative. Ethereum and Solana compete on execution and programmability. XRP competes on settlement, liquidity, and interoperability. Each plays a different role. Pretending they all do the same thing only leads to bad assumptions. So when you hear someone say XRP is just speculative or does nothing, what they're really revealing is that they haven't studied how global payments actually work. Because in that world, speed, certainty, and cost are not optional features. They are requirements. And when you step back and look at the direction the financial system is moving toward instant payments, tokenized assets, and real-time settlement, it becomes obvious that assets built specifically for that environment have an advantage that doesn't show up immediately on a price chart. Now, this is where everything you've heard so far starts to converge, because payments alone are only one piece of the puzzle. The much bigger shift happening right now is tokenization, and this is the part most people are dramatically underestimating. Tokenization isn't about making crypto more exciting. It's about turning financial assets into software. Stocks, bonds, ETFs, funds, real estate, commodities, all of it moving onto digital rails, so settlement becomes faster, cheaper, and programmable. And the key thing to understand here is this: private financial systems cannot scale tokenization on their own. They need public liquidity rails to function properly. That's where organizations like the DTCC come in. The DTCC sits at the center of global finance, holding and settling tens of trillions of dollars in assets. When they talk about tokenizing securities, they are not experimenting for fun. They are solving a coordination problem. If every institution tokenizes assets in isolation, liquidity fragments, risk increases, and the system actually gets worse. So the solution is to tokenize at the foundational level and allow assets to move across different blockchains in a standardized way. This is why you keep hearing language about L1s and L2s, about public chains and settlement layers, about interoperability instead of isolated ecosystems. Tokenized assets still need deep, neutral liquidity to move efficiently, and that liquidity cannot live entirely inside closed systems. It has to bridge across them. This is where XRP quietly fits into the picture. XRP Ledger was built to settle value, not host complex applications. That's not a weakness. That's a specialization. In a tokenized world, you don't want every chain doing everything. You want execution chains, data chains, and settlement chains. And settlement chains need to be fast, cheap, neutral, and legally usable. This is also where ISO 2022 adoption becomes important. When countries and central banks start upgrading their payment systems to instant standardized messaging, they are laying the groundwork for interoperability. Smaller nations rolling out ISO-based instant payment systems are not copying Silicon Valley trends. They are modernizing their financial infrastructure so it can connect globally. And assets that already align with those standards have an advantage that doesn't require marketing. What matters here is not whether XRP is mentioned in every press release. What matters is whether it solves the settlement problem that tokenization creates. When assets move faster, when markets run 24/7, and when value is represented digitally, settlement becomes the bottleneck, and bottlenecks are where infrastructure assets gain relevance. This is why the conversation shifts away from which coin will pump to which system can handle scale without breaking. Tokenization increases volume. Volume increases stress. Stress exposes weak infrastructure. And institutions don't wait until something fails to choose their tools. They choose them in advance. So when you see conversations about public blockchains supporting private finance, about regulated access, about interoperability, about real-world assets moving on-chain, you're not watching a trend. You're watching architecture being finalized. And once architecture is finalized, behavior follows. Now let's zoom all the way out, because if you're still trying to force everything in crypto into the old 4-year cycle narrative, you're likely using a model that no longer fits the system that's being built. And that matters a lot for how you think about XRP, Bitcoin, and the broader market heading into 2026. For a long time, people believed crypto moved almost mechanically with halvings, blowups, and speculative excess. That framework worked when crypto was small, underregulated, and driven almost entirely by retail emotion. But that environment is changing fast. ETFs, regulated custodians, clearer rules, and institutional liquidity are fundamentally altering how capital enters and exits this market. That's why you're hearing respected voices argue that the 4-year cycle is weakening or even breaking down. The halving removes less and less supply impact each time. Interest rate cycles are shifting in the opposite direction. And the big blowups that define past cycles are harder to repeat in a world with qualified custodians and stricter oversight. At the same time, something much larger is taking over as the dominant driver: liquidity. Liquidity explains most major price movements across all risk assets, not just crypto. When liquidity expands, assets rise. When it contracts, assets fall. And looking ahead to 2026, the macro conversation is increasingly centered on easing, refinancing, fiscal stimulus, and structural liquidity returning to the system. That doesn't mean prices go straight up. It means the backdrop is changing in a way that favors assets embedded in the financial system rather than sitting on the fringes. This is where XRP's positioning becomes especially interesting. XRP is not dependent on hype cycles to remain relevant. It's tied to payments, settlement, tokenization, and interoperability, areas that continue to grow regardless of retail sentiment. If liquidity expands and tokenized markets accelerate, infrastructure assets benefit simply by being used, not because people suddenly get excited on social media. That doesn't mean XRP is guaranteed to succeed. Competition exists, timelines slip, adoption can be slower than expected. Anyone telling you otherwise is selling certainty that doesn't exist. But there is a clear difference between blind speculation and understanding where structural demand could come from. XRP sits much closer to the structural side of that equation than most assets in this space. The biggest mistake you can make here is emotional thinking, either extreme optimism or extreme dismissal. Markets don't reward either. They reward clear thinking, patience, and the ability to separate noise from signal. If you understand that institutions think in systems, that liquidity drives cycles, and that infrastructure is positioned long before it's obvious, you stop feeling whipsawed by every headline. So when you hear questions like, does BlackRock already own XRP, don't get stuck on the literal wording. The deeper question is whether the rails being built today align with how large capital will need to move tomorrow. Ownership is visible, integration is subtle, and history shows that subtlety matters far more in the long run. And before we end, it's important to be crystal clear. This video is for educational and informational purposes only. Nothing discussed here is financial advice. I'm not telling you to buy, sell, or hold XRP or any other asset. You are responsible for doing your own research, understanding your own risk tolerance, and making your own financial decisions. Crypto markets are volatile and risky, and you should never invest money you cannot afford to lose. If you got value from this breakdown, take a second to like the video, share it with someone who's trying to understand what's really happening in this space, and subscribe so you don't miss future updates. I'll keep breaking things down calmly without hype and with the bigger picture in mind.